This class is Derivative Securities. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a chief economist and an adjunct professor of accounting and financial management. In today's lecture, we will cover the second half of trading strategies involving options from the excellent text Options, Futures, and Other Derivatives by John C. Hall. Our next topic is butterfly spreads using calls. A butterfly spread is an anti-volatility bet. So we've looked at bull and bear spreads. Bull spreads allow you to make money if the underlying security goes up, but limit your losses if they go down. Bear spreads allow you to make money if your underlying security goes down, but limit losses if it goes up. A butterfly spread will allow you to make money if your underlying security doesn't change in price very much. The one using calls is constructed by a total of 4 different call options, going long a call at K1, also long a call at K3, a strike price of K3, and then shorting 2 calls with a strike price of K2. This can be written out by the profit equation at the bottom. So we see purchasing or going long the call with the strike of K1 minus C1 plus maximum of S minus K1 comma 0. Going long the call with a strike of K3 minus C3 plus maximum of S minus K3 comma 0. And then shorting 2 calls with a strike price of K2 plus C2 minus 2 max of S minus K2 comma 0. As in our past lectures, we will now split up this profit equation into multiple different sections, in this case 4 of them: the region S less than K1, the region S, the stock price between K1 and K2, the region S, the stock price between K2 and K3, and the region S, the stock price above K3. If we are below K1, then none of the calls are in the money, so all of these maximum terms yield a 0, and we're just left with minus C2 minus C3 plus 2 C2. So this negative down here, our maximum loss. If, on the other hand, we are between K1 and K2, then one of our options, this one right here, is in the money. So we will have this term plus S minus K1, and we can check at our transition point if S equals K1, it equals the previous term. Next we can go, what about if S is between K2 and K3? Well, in that case, this option is in the money, and these 2 options over here are in the money. So we will have all of our call option prices. We will have an S minus K1, and then we will have over here minus 2 S's plus 2 K2. So we end up with a plus 2 K2, and our minus 2 S's cancel one of our positive S's here, giving us a minus stock price. Again, we can check at our transition point. If S equals K2, then we are going to equal this term right here. So we will have S equals K2, K2 minus K1. Here, if we have S equals K2, then we will have 2K2 minus a K2, or a K2 minus K1, just like here. What about our final area over here, the stock price greater than K3? Now all of the options are in the money. So we have, again, the purchase price of all of our options. And all of our S's are now going to cancel out because we're going to have minus 2S here, plus S here, plus S here. And then we were left with all the K's, a minus K1, a minus K3, and a plus 2 K2. Again, checking the transition. What if S here equals K3? Then, yes, these 2 terms are equal. So that is our anti-volatility bet. If you wish to bet that a stock is going to stay near the strike price K2, you can make money off this. If you are wrong and the stock either goes up or down too much, then you will lose money. The next topic we will discuss is similar to the last one. Now we will do a butterfly spread using puts. Just like the call spread, this spread will be constructed from 4 different options. In this case, we will go long a put with a strike price of K1, long another put with a strike price of K3, and short 2 puts with strike prices of K2. We can write this equation right here. Here is our first put with a strike price of K1 minus P1 plus maximum of K1 minus S comma 0. Here is our long put with a strike price of K3. And here are our 2 short puts with a strike price of K2 plus 2P2 minus 2 max of K2 minus S comma 0. We will first examine the region for the stock price less than K1. In that region, all of the puts will expire in the money. So we will have our component here of all of the put premiums, and then we will have to add up all of these in the money terms. So we will get K1 plus K3 minus 2K2, we get that. And then all of the stock prices in this case cancel out. We get plus 2 S's from over here, minus an S from this, minus an S from here. So we were just set with this term, which is our maximum loss here. Now how about the region between K1 and K2? Now 2 out of the 3 options expire in the money. The first option here expires out of the money, so this max gives us a 0. And from here, we will have a K3 minus S, so we get the K3, we've got a minus S. Here we get minus 2K2, we have that. And our minus S from here is canceled by a plus 2S from here, so we end up with a plus S, and we have this upward sloping term right here. If we stick in this S equals K1, we can see it equals the previous term, so we are continuous at the boundary points. What about in the region S between K2 and K3? Now this put, the first put, and the final listed put expire out of the money, and we only have the medium term here, so we end up with all of our put options, the premiums of them, plus K3 minus S. Again, we can check our boundary point, and we can stick in S equals K2, we will have K3 minus S, and here if we stick in S equals K2, we end up with K3 minus S. So our boundary point is correct. For the final region over here, the other maximum loss point, all of the puts expire out of the money, so all the max terms give 0, and we're just left with the cost of the put premiums. And again, we should check our boundary point. What if S equals K3? Well, these cancel, and we end up with this being correct. So that is a butterfly spread using puts, which is again an anti-volatility bet. You are betting your stock will not change much from the price K2. Now we are going to look at calendar spreads using both calls and then puts. Calendar spreads, similar to the butterfly spreads, are anti-volatility bets. That means you make money if the underlying stock price stays near the initial strike price here. You lose money if the stock price drops too much or if the stock price goes up too much. These are constructed by using 2 different options. In this example, going short a call that is about to expire and going long a call that has a long expiration date. So the payoff right here on the day of expiration of the short call is plus C naught minus maximum of S minus K comma 0. And then here is still the value of the long call, the minus CT you have paid for it, plus the payoff of max S minus K comma 0 minus the remaining time value. So why would it pay off this way? Well, the time value of an option decays very quickly as you approach the expiration date. Therefore, the long-dated option, the time value doesn't go down very much, but the short-dated option goes down very quickly. So if you stay right in this region, you can make money off of that. On the other hand, if the stock price goes up too much, too far in the money, or too far out of the money, then the time value goes away anyway, and you still lose money because you have paid more for the long-dated option than the short-dated option. We can also construct a calendar spread using puts. Similarly, you are shorting a near to expiration option with a strike price K1, and you are going long a long-dated put option also with a strike price K1. So your payoff here from the short option is plus P naught minus maximum K minus S comma 0, and then the value of expiration of the long-dated option that you have purchased. So we sold the short-dated option, we purchased the long-dated option with minus PT maximum K minus S comma 0 minus the time value. So again, the profit on the day of expiration of the short-dated option is what you get paid for the short-dated option minus the change in time value minus the price you paid for the long-dated option. And again, the way this works is the time value of the short-dated option decays a lot quicker than the time value of the long-dated option. So you make money if the stock stays near K, but the time values for both options goes away if the stock price goes up or down too much, and then you lose money. This can be shown on this graph where you see the time value decay of an option price. The option value decay goes down very quickly in this example the last 30 days, but if you have like a 120-day option, the slope here is pretty mild compared to a drastic slope here. And also, if we look here on the time value of a call option versus the asset spot price, you can see the time value is very large in this region near at the money, but if you go way out of the money for both a long-dated and short-dated option, the time value will go away, and if you go very far in the money, it will also go away. So the only way of making money on a calendar spread is if the stock price stays near at the money. Our next topic is a straddle combination. So both the butterfly spreads and the calendar spreads were anti-volatility bets. Of course, you could inverse them and make them volatility bets. A straddle combination is a volatility bet. So if you wanted to bet an underlying stock is going to go up or down a lot, you could do a straddle on it, and you would lose money if the stock stays near the strike price, but make money if the stock either drops a lot or goes up a lot. And this can be created by going both long a call and long a put. So here we have our long call, here we have our long put, both with a strike price K. So the payoff on the day of expiration is minus C plus max S minus K comma 0 minus P plus max K minus S comma 0. In the region S less than K, the call option here expires at 0, but the put option pays off, so you end up with minus C minus P plus K minus S. In the region, on the other hand, for S greater than K, then the call option pays off and the put option expires at 0, so this term goes away, but we get an S minus K for here. We should also check the transition point. At the transition point, when S equals K, both of these second terms go to 0, and we have our maximum loss of paying for both the call and the put option, getting no payoff and losing the maximum amount of money, which is minus C minus P. Our maximum profit on this side is infinity. On this side, for S less than K, if we put in S equals 0, our maximum profit would be K minus C minus P right at this point. Other types of volatility bets would be strips and straps. which are also combinations of going long calls and long puts. In one case, you go long two calls, and in one case, you go long two puts. So we'll look first here at the strip, this graph right here. For the strip, we go long one call option, minus C plus max S minus K comma 0. And we go long two puts with the same strike price, so minus 2P plus 2 max K minus S comma 0. In the region for S less than K, the call option expires worthless, but the put option has value, so we end up with minus C minus 2P plus 2K minus 2S. Our maximum profit on this side when S equals 0 is then 2K minus 2P minus C. On the other hand, for S above K, then our put option expires worthless, but our call option pays off, and we end up with minus C minus 2P plus S minus K with a maximum profit of infinity. If S equals K, then in both cases, these terms cancel, and we end up with our maximum loss of minus 2C minus 2P. So that is the strip. So we just did the strip. Now we will do the strap, which is a very similar combination of options, but now you are going to be buying two call options and only one put option. So you get a payoff that looks like this. Again, both of the options will have a strike price K. So our profit will be minus 2C plus max S minus K comma 0 minus P plus max K minus S comma 0. For S less than K in this region, then we get a payoff from our put, but our calls expire worthless, so we end up with minus 2C minus P plus K minus S. For the region S greater than K, then our put expires worthless, but our calls pay off, and we get plus 2S minus 2K. So checking our transition points, if S equals K, both of the second terms here go to 0, and we have our maximum loss of minus 2C minus P. If S goes to 0 right here, then we end up with our profit max on the left of plus K minus P minus 2C right here, and then on the right, as for all call options, the maximum profit S goes to infinity is infinity. How about a strangle combination? Well, this is very similar to the previous straddle, except now K1 and K2 are different. So we have a gap here, a long flat area of maximum loss. So a straddle combination is created by being here long a put at strike price of K1 and long a call at strike price of K2. So the profit payoff will look like this, minus C1 plus maximum S minus K2 comma 0 minus P1 plus maximum of K1 minus S comma 0. We can again split it up, in this case, into 1, 2, 3 regions, starting with the stock price less than the strike price K1. Well, if we are less than K1, then our call option here expires worthless, but we do get paid off here with our put option. So we end up with minus C1 minus P1 plus K1 minus S. If we are in the region between K1 and K2, both of our options expire worthless, so we just end up with paying for the options minus C1 minus P1. If we are in the region S greater than K2, then our call option pays off, but our put option expires worthless, so we get our term S minus K2 and the price we pay for the options. Checking the transition point, well, if S equals K2, this term goes to 0. These two terms are equal. If S equals K1, this term goes to 0. These two terms are equal. We can also look at our maximum profits on both sides. If S goes to infinity, the profit here is infinite. If S goes to 0, then the profit at this point is going to be K1 minus C1 minus P1. So that is another volatility bet, a strangle combination, and you will make money if the stock price goes up a lot or down a lot. If it stays between K1 and K2, or not too far, much below K1 or too much above K2, then you will lose money. The break-even point you could also find right here by setting this profit equation equal to 0 and then solving for S, and S would equal, if you move S to the other side, K1 minus C1 minus P1. You can find this break-even point here by setting this equation equal to 0, and then moving all these items to the other side, and you will end up with K2 plus C1 plus P1 would be that break-even point. Other possible payoff patterns: when the strike prices are close together, a butterfly spread provides a payoff consisting of a small spike. If options with all strike prices were available, any payoff pattern could at least approximately be constructed by combining the spikes obtained from different butterfly spreads. So in theory, you can create any payoff pattern you want from options. Of course, there are limits in the liquidity of the various options. That is the end of today's lecture. I thank you for watching this video.